Now let us move to reading 47 of study session 13, Security Market Indices. Under this LOS, we will look at what is a security market index and what are the different returns we can calculate on an index: price return, total return. Then we'll look at the choices and issues involved in the construction and management of the index. Then we'll look at various weighing methods which are used in the index construction, return of an index basis on its weighing method. Then we'll look at the rebalancing and reconstruction of the index, the use of security market indices, various types of equity indices and fixed income indices. Then we'll look at the indices which represent alternative investments, and finally the type of security market indices. So let us start with the definition. The security market index is used as a benchmark to evaluate the performance of money managers, asset class or segment of securities. So this is an index which will give us a holistic idea about the whole market. So that is how we can use it as a benchmark in order to evaluate the performance of money managers. If their portfolio is giving more return than the market index, that indicates that the managers are outperforming the market. So this is used to monitor an index fund. Since index fund is just the replica of the market, it is also used for prediction of future market values. There are various weighing schemes for the performance of securities values. We'll look at them in subsequent slides. Now let us look at the returns on the index. First is price return. So this return is because of appreciation in the price. So it measures the percentage change or appreciation in the price of security. For example, in the beginning there was certain price P0 and in the end there was price P. So we can calculate the price return as P by P0 minus 1. For example, beginning price was $100, that is P0, and ending price is say 120. So we can say 120 divided by 100 minus 1, that is 0.2 or 20%. This is the price return. This return is due to the appreciation in the price. This is also called capital gain. So here we have ignored all the dividends and other earnings on the security. We are just looking at the price. But when we look at the total return, we need to consider all the dividends and payments. So where we talk about total return, we need to include the cash flows. In addition to the ending price, we need to look at the dividends, etc. as well. So here we are assuming that all the dividends and distributions are reinvested in the index. So this is better measure than the price return since it is including the cash flows also. So this is giving us a complete picture. For example, earlier if the beginning price was $100, ending price was $120, and there has been a dividend paid say for $10, then this 10 will also play a role in calculation of total return. So ending price 120 plus cash flow, which is 10 divided by 100 minus 1. So this will be 30%. So since we are including 10% return due to dividend as well, so total return represents better picture of the index return. Now let us move to the next slide. We'll look at what are the choices available and what are the issues involved in index construction and management. So in order to pick up an index, several decisions need to be made by the index providers. For example, which target market should an index represent? So this index should represent a particular target market. Then which security should be selected from that target market so that the market is represented well in the index. Then what should be the weight given to each security in that index, and once the index is created, then how should it be rebalanced, and when this rebalancing and security selection has to be re-examined. Now this target market can be classified into these 4 categories. It could be broad market where the index is covering all the securities in US market. It could be a narrow market. For example, small cap securities in US market is covering only small cap securities. So it is a narrow market index. It could be a geographic index which is covering securities belonging to a particular region. For example, India, Japan or China index. Then it could be economic sector based index. Suppose one index is covering only cyclical securities. So this is one kind of economic sector that the index is representing. So this is target market which the index should represent. Now let us move to the next topic. Now let us look at the different weighing methods used in index construction. So first method is price weighted index method. In this, each component stock contributes only its price while determining the overall index value. This is the simplest method to calculate the index value. Here, since we are just taking some of the securities, obviously the more weight will be given to stocks with a higher price. So if there is a small change in the stock with the highest price, then there will be a significant change in the index value. So it is easy to compute because it is simply arithmetic average of the prices of all securities included in the index. So the example is Dow Jones Industrial Average, which is one of the most important index, and Nikkei Dow Jones. So the index can be calculated as sum of the securities. This is just the summation of all the prices and divided by total number of securities. But that has to be adjusted for stock split. So clearly if there is a stock with a price of $10,000 and there's another stock with the price of say only $10. So if there is a change in this stock, suppose there is only 5% change, so that will amount to be $500. And if there is a 10% change in this $10 stock, it will be just $1 change. So the stock with the lower price will have a smaller impact on the index. The stock with higher price will have a larger impact on the value of the index. So that is a drawback of this index. Now let us look at the other methods for index construction. Another is equal weighted index. So here it is representing the performance of each stock in equal proportion regardless of the market capitalization. So we are not looking at the prices or market capitalization of a particular stock. Each stock is equally weighted. But the drawback here is, since each stock will not represent overall economic health or market performance, smaller companies are going to have a lower impact and larger companies will have a higher impact. So logically, a very small company should not have an equal representation in the index. So that is a drawback. The example is value line composite average and Financial Times ordinary share index. So they are using equal weighted index where each company has given equal weight, whether small or large. Let us look at the another method, which is market capitalization weight method or value weighted average. So this is one of the most commonly used methods in which companies are apportioned according to their market capitalization. So the company with higher market valuation or capitalization is going to have higher impact on the index. So the company with lower market capitalization or lower market value is going to have lower impact on the index. The primary criticism of this index is that large companies are going to have a large impact since they have large share in the index. But since it is believed that the larger companies are going to have large impact on the economy, they are believed to be good representative of the economy. The examples are Standard and Poor 500 and Russell 1000. These index are based on market capitalization weighing method. So the formula is price into number of shares, which is the market capitalization of the company, divided by base year price into number of shares, that is market capitalization of base year into beginning value of the index. We'll take a numerical example in subsequent slides. Now let us look at another method, which is market float. So earlier we are looking at total market capitalization of the companies Here we look at the total values of share which are actually available to investing public, and they are excluding the value of shares which are held by controlling shareholders. They are controlling shareholders who are not trading their shares in the market. So we are excluding them and calculating the index value based on actually available shares, which is market float. Similarly, we have free float where we are excluding even the shares which are not available to foreign investors. So in order to calculate float adjusted market capitalization index, the number of securities which are investable and excluding the shares of controlling interest and those held by government and corporations. Since these shares are not being traded in the market, they are excluded. So that indicates that stocks which are possibly overvalued are given disproportionately higher weights in the index. That is a drawback. And similarly, the stocks which are undervalued are given disproportionately lower weights in float adjusted market capitalization index. So that is a weakness. So there is one more method used for index construction, which is fundamental weight index. Here we are using the fundamental numbers for weights rather than the market capitalization as the previous case. So these fundamental indices are style indices because of the fundamental measure. They are tending to tilt towards certain styles, usually values. We know that one kind of companies might have one kind of fundamental numbers. So that is why they are tilted towards one kind of style. So the most obvious measures for fundamentally weighted index could be accounting numbers. It could be book value, it could be revenues or net profit or cash flows, etc. So here dividends tend to bias the selection towards the value stocks. Here since we are using these accounting numbers, so the index is not going to be influenced by price. So since price is influenced by short-term emotions, so these prices errors which are mostly random will be avoided in this case. So it does not use any relative or absolute value to determine company weights in the index. Only fundamental weights are used. Now let us look at numerical example to differentiate between these weighing methods for index construction. First is price weighted index. Suppose the share price for these stock ABC on 31st December 2011 is given and 31st January 2012 is given. So we want to calculate that during this period what has been the change in the index. So let us calculate the index in December 2011. Price weighted average is simply arithmetic average. So 15 plus 25 plus 60 divided by 3, this is index at this point in time, and 20 plus 20 plus 40 divided by 3 is share price, index price at January 2012. So we can see the difference between these two and find out what has been the percentage change in the index. So if we take this as 100, we can calculate in terms of index value. What is the new index value? So let us calculate. So for beginning period, it was 33.33, 15 plus 25 plus 60 by 3. For the next period, it was 20 plus 20 plus 40 by 3, which is 26.67. So there has been a drop. So we can calculate in terms of percentages. So it comes out to be drop of 19.98%, approximately 20%. So if the index in the beginning period was 100, it will drop to 80, 20% drop at the end of the period. So this is how we can calculate price weighted average index. Now let us take another example for value weighted index. Suppose on May 31st, this was the prices for these securities XYZ. $30 for 200 securities, $20 300 securities, $40 100 securities. So we can calculate market value by just multiplying these numbers. 30 into 200 is 6,000, 20 into 300 is again 6,000, 40 into 100 is 4,000. So total market value of all the securities under this index is going to be 6 plus 6 plus 4, 16,000. Similarly, on June 30th, we have different prices. The price of security X has dropped to 22. The price of security Y has risen to 28. and similarly it has changed from 40 to 45. Now we have new price for all these securities, but number of securities are same. Market value is going to be different since the price has changed. So let us multiply these three. 22 into 200 is 4400, 28 into 300 8400, and 45 into 100 is 4500. So sum of this is 17,300. So we can clearly see that there is 1,300 increase in the total market value. But if we look at the price average, it was 90 earlier, sum of it was 90, so 90 divided by 3 was $30. So this was the price weighted average, and here it is 95 divided by 3, so it is going to be $31.66. So there has been a different percentage change in the case of price and different percentage change in the case of market value. So assuming that in the beginning of the period it was 100, so we can calculate 17,300 divided by 16,000 into 100. So it is 108.125, or change of 8.125% in the total market value. But if we look at the change according to the price weighted average, so earlier it was 90 divided by 3, that was 30. Later it became 95 divided by 3, that was 31.66. So the percentage change comes out to be 5.55%, which is less than 8.125%. So why according to price weighted average the percentage change is lower? Let us look at in the table. Here the market value is highest in X and Y, lower in the case of Z. So changes in X and Y will be more prominent. Here there has been drop of 6, here there has been increase of 8 in the price, and change in market value, let us see, 6,000 to 4,400 and 6,000 to 8,400 here. So this impact is going to be more, while in the case of price weighted average the change in Z is going to be more prominent. So since this rise was small, the rise in the price weighted average was small, since Z will be most important in the case of price weighted average. That is why the number for price weighted average index is just 5.55%, while for market value weighted average is 8.125%. So in this case, the more weightage is given to the one which has highest market capitalization, while in the case of price weighted average, more weight is given to the one with highest price. So that is why the difference is coming between these two. Now let us take another example for equal weighted index. As we already seen that in this case equal weight is going to be given to all the securities irrespective of their prices and market value. So if the initial cost was 35 for security A and the current price is 30, so we have certain percentage drop, A percent drop, and for B suppose there is a certain percentage B percentage rise, and for C there is another C percentage rise. So we are going to treat them equally. We are not going to get influenced by the prices of the security or market value of the security. We simply take the arithmetic average of these percentages. So let us calculate that. Initial cost was 35, current price was 30. So drop of 5 on 35. So it is about 14% drop. In this case 10 to 15 is 50% rise, and 20 to 24 is 20% rise. And if we have to calculate the total change in the index value, we have to simply take the arithmetic average of these holding period returns. So we have these holding period returns as current price divided by base price into 100. Now we just take the arithmetic average of these three. So minus 14 plus 50 plus 20 divided by 3, we get 18.67%. So this is the average rise based on equal weightage. So if the initial index value was 100, the current index value is going to be 18.67% higher than that, that is 118.67. So that is how we calculate index based on equal weightage. Now let us move to the next slide. Rebalancing and reconstruction of the index. Since we know that prices of the index keep changing, so that might have an impact on the weightages as well. So time to time the index has to be rebalanced and reconstructed. For rebalancing, we need to check the weights of the constituent securities in the index, whether it has changed. Now it is done to maintain the weight of each security consistent with the index weighing method. So in order to check that, we need to look at the new weights. And there is no need to rebalance the price weighted index, since price weighted index are just average of the prices, so they are going to have the weights based on the prices all the time, so there is no need to rebalance. For reconstitution, we need to change the composition of the index due to addition or deletion of security, so that is known as reconstitution. So if there is a new security which has been added to the index, or if there is security which is going out of the index has to be reconstituted, since the weights will be changing for all the securities. So it helps to ensure the index targeting a particular desired market. Let us move to the next slide. We look at the uses of the security market indices. So one of the most important function is that it reflects market sentiments as how will index perform. So that sentiment will be reflected in the index. The second use is it used as benchmark to compare the performance of portfolio managers. So we can easily check that index has given the return of say 20%. If the portfolio manager is giving more than that with the same amount of risk, that says that portfolio manager is outperforming the index. So that is how the index can be used as a benchmark to compare the performance. The third important use of the security market index is that we can measure the volatility of the particular sector by just measuring the standard deviation of index of that particular sector. So that becomes very easy. So the greater the standard deviation of the index, higher is the volatility of the sector and higher is the investment risk for a short period of time. And finally, the index helps in evaluating the return based on the index risk, which is captured by standard deviation. So we get a fair idea from the index that what should be our Sharpe's ratio for a particular index. Another advantage is that the various market indices make it very easy to see the correlation among them. So if two sectors are moving together, we can simply look at the index of those two sectors and see the correlation. And then the investors can reduce the risk by investing in different securities. So they can see if two sectors are negatively correlated, then they will get the diversification advantage. So if there's no correlation or negative correlation, then it is a better portfolio. So that idea can be easily explored using sector indices. Another advantage is for the passive investors who do not want to do any research, they just invest in the index funds, which is nothing but replication of market index itself. And finally, as we have already seen, it helps in measuring the risk adjusted returns. For a particular amount of risk, what should be the expected returns for a particular kind of sector. That idea is given by the security market index. Now let us look at the next topic, which is types of equity indices. So we can have various kind of equity indices. For example, broad market index, the index which covers almost all the companies of the market. So it measures the performance of the market and it is acting as a yardstick which contains more than 90% of the market's total value. So it is better representative, although it is difficult to calculate. For example, Wilshire 5000 index. Then we can have multi-market index. This is the index which is constructed to measure the returns of indices from different geographical areas or market based on different stages of economic development, for example developed or emerging markets and entire world. It is basically capturing different markets. Then we can have multi-market index, which is covering different markets from different geographical areas and different stages of economic development, along with the fundamental weight. So here the index providing weights to the securities within each country by market capitalization. So within each country it is based on market cap, and then we are giving a weight to each country based on the relative GDP. So within the country, weight is based on market cap, and to each country weight is given based on the relative GDP. So that is how we calculate multi-market index with fundamental weighing. Let us look at a few other types of indices. The sector index, which measures the return from a particular kind of industry. For example, food industry, healthcare, etc. So these are the different sectors for which we have a specific index. So that will give us an idea about how in general the industry is performing. So the investor need to analyze the investments because some industries are cyclical in nature and which will perform accordingly in cycles, for example automobiles, and there could be another kind of sectors which are not affected so much by the business cycle. So sector index can be for a particular country. For example, we can have pharma index or IT index, etc. Then we can have style index, which is a type of fundamentally weighted index which is designed to provide a yardstick for one kind of strategy. So which will have, suppose, growth stock or value stock. This is one kind of style. So one kind of style is combined into one kind of index. For example, we can have value index or growth index, etc. Let us move to the next slide. So we already looked at the types of equity indices. Now let us look at types of fixed income indices. So broadly they can be classified into two categories. One is large universe index, another is dealer market and infrequent trading index. So for the large universe, as the name suggests, it covers much broader universe than the stocks. It covers fixed income instruments not only given by firms but also by government agencies. So the only problem here is that a bond matures while stocks may last for a longer period of time. When the bond matures, they need to be replaced in the index. So that is why the turnover is very high in the fixed income indices, because every time a bond matures, it has to be replaced by some other bond. While in the case of stock, rarely one stock is replaced by another stock in the index because stocks do not mature. Then we can have dealer market and infrequent trading index, where the prices are quoted by the dealers. So liquidity is not generally very high. So these dealers primarily trade fixed income instruments, and when the prices of exact trade are not available, then different securities with similar characteristics are used to find out the price. So these fixed income securities can be differentiated on the basis of maturity, types of issuer, country, region, sector, and the quality of collateral, etc. So based on that we can categorize fixed income security, and accordingly we can have different indices for different kind of fixed income securities. Now let us look at the other indices representing alternative investments. There are three kinds of alternative assets. One could be commodities. For them we have commodity index, which represent the future contracts on commodities such as wheat, precious metals like gold, silver, etc., energy. So we have a commodity index which represents the price changes in any of these commodities. Then another kind of alternative assets could be real estate. For that we can have various kinds of real estate index. It is constructed on the basis of return due to appraisal value of properties. Since the property market is not very liquid, so we cannot see the actual transactions for all kind of properties, we need to depend on appraisal value of properties or by the performance of real estate investment trust, where we have a lot of properties which are being traded. So based on the performance of the REIT, we can find out the index value. So this is very similar to the closed-ended mutual funds, since they are investing in the properties and the ownership interest is issued to the pool of investors. The advantage is that REITs are more liquid as compared to real properties. So FTSE International is producing a family of REIT indexes based on various characteristics of the properties. They can be put into different index. The third kind of alternative assets are hedge funds. So we can have hedge funds index to represent the performance of the hedge funds. Since the hedge funds collect the money from various investors and they are forming a pool and they invest in non-traditional assets using leverage. Since they are unregulated, their strategies are not disclosed and they are free from reporting their performance. So that is the drawback. Because of this non-transparency regarding reporting, the actual performance is difficult to measure. So that is why there is an upward bias because of self-selection and survivorship bias. That is, if there are certain funds which have not been able to give proper returns and they cease to exist, they are excluded from the calculation. So that brings a survivorship bias. So the only hedge funds which have performed well and survived are used in the calculation of index. So that creates a problem of survivorship bias. Now let us look at a few examples of security market indices. First is Dow Jones Industrial Average. This is based on US blue chip companies. There are 30 blue chip companies of United States, and this is based on price weighting method. We have seen various kinds of methods for construction of index. For DJIA, price weighting method is used. So this is oldest and most widely used US equity index, and these 30 stocks are from large mature blue chip companies. Similarly, in Japan we have Nikkei stock average, which includes 225 blue chip companies of Japan, and it uses modified price. So this mechanism of weighting is slightly different from this price weighted method. Because of the extreme variations in the price level of component securities, some high price shares are weighted as fraction of the share price. So that adjustment made it modified price method. So these index also contain certain illiquid stocks. The another example of security market indices could be TOPIX, where all companies listed on the Tokyo Stock Exchange first section are included. So as per the definition, it is a broad market index. The number of securities included varies and it uses float adjusted market capitalization. We have already seen it exclude the market capitalization of those shares which are not being traded in the market. So it represents about 93% of the market value of all Japanese equities. That is why it is broad market index. It contains a large number of very small illiquid stocks as well. So which makes the replication very difficult because an investor may not want to invest in a small illiquid stock. So that is why replication of this portfolio is difficult. Let us look at few other examples. The MCSI All Country World Index. Since it is All Country World Index, it includes 23 stocks of 23 developed countries and 22 emerging market countries. So number of security varies and the weighing method is used as free float adjusted market capitalization. It composed of companies which are representative of the market structure of developed and emerging market. So it could be various geographical regions, and in this price return and total return versions are available in both US dollars and local currencies. Another example is S&P Developed ex-US BMI Energy Sector Index. So this represents the energy sector of developed global market outside United States. Number of securities varies. The weighing method for construction of index is float adjusted market cap, and this is serving as a model portfolio for SPDR that is Standard and Poor Energy Sector Exchange Traded Funds. So this is a model portfolio for this ETF. There could be many other examples. Now let us take a few questions here.